I'm Michael Fox, and this is the Prospector Podcast. And I have joining me, as he always does the day after the Fed announcement, Chris Temple of the National Investor. Welcome, Chris.
Hey, Mike, how are you?
I am doing well, other than my head is absolutely spinning because I can't figure out what the hell it was that Jay Powell had to say yesterday.
Well, good. He
Um,
can't. He can't either.
But he did hold the line on the interest rates as was expected, and then he stepped up to the mic and said one thing, contradicted himself, said something else, contradicted it that way, and I threw up my hands. So, Chris, what the hell was that?
Well, look, I sent out a note with a couple of new recommendations, or actually one new and one renewed recommendation to my members this morning. But before I get into that, and telling people to stay tuned for your discussion and mine, to get deeper into the Fed meeting, one of the things I did point out was that there was a rather stark contradiction yesterday that Powell got called out on one time, big time, by one of the reporters at this press conference, and then a couple of lesser times. But, I suggested going into this that despite some calls that the Fed should ease somewhat in its monetary policy stance because of the weakness in the stock market of late and the recession fears and whatnot, I did not think that the Fed was going to move at all. I was correct in that. In fact, in sticking with only two 25 basis point rate cut predictions for 2025, the voting members actually firmed up that stance. They didn't kind of soften and go the other way. So that's how they see things now. The contradiction comes, however, when at the same time that they dialed down significantly their GDP forecast for this year from 2.1 to 1.7% for the year, it may be close to flatline for the first quarter when the numbers come out in a couple of weeks, actually. They raised their prediction for core CPI, their favorite measure. Instead of saying it would be 2.5% by year's end, they said it's going to be still 2.8%. So in that context, you've got to ask, okay, well, if you're saying that interest rate or that inflation rather is not only sticky, but is going to continue to tick back up somewhat, in part due to tariffs. And if you're telling us that not that long ago you said everything is on the table, hell, you may even need to reverse course and raise interest rates again if inflation picks up. Why are you telling us today that you're still going to cut rates twice with inflation moving higher rather than lower? And that was where things kind of got muddy and interesting and contradictory for the Fed yesterday. And in my view, without coming right out and saying it, Jerome Powell did two things. Number one, he telegraphed that, yes, we are in the great stagflation. We're going to have weaker growth. We're going to have higher costs, in part due to tariffs. And also that the Fed may never see its 2% inflation target. They still try and tell us that by 2027, we'll be down to their 2% target, but that keeps moving out. And so there's been chatter for a while among Fed watchers, Mike, that, will the Fed officially run up the white flag and say, you know what, we just can't get back down to 2%. We're going to do the best we can, but we're not going to do so much to try and get down to 2% that we tank the economy. And if that's what they're doing, then when you net it all out, and I still do think that we're in a rolling correction on Wall Street, but when you net it all out, you have to be a bit less bearish today on stocks and on industrial commodities than you would have been going into the Fed meeting.
You and I have talked over the last couple of years about stagflation light coming back, and what I heard from Powell yesterday is that we might have underplayed that, and 1970 stagflation is on its way and it's knocking on the door.
Well, it is for a lot of reasons. And again, the Fed, as always, and Powell specifically, is hugely hypocritical and disingenuous when it talks about this, because as I've pointed out a million times, the single biggest, most proximate cause of the rebound in inflation that we had over the last few years is looking back at Fed Chairman Powell when he looks in the mirror. He's the guy that led the charge to create 30% of the US dollars that ever were created in the entire history of the US of A inside of about 2 years in the name of saving us from COVID and from the self-inflicted recession and everything else that came with that. So it doesn't take a rocket scientist to figure out that when you create that much money without any productive place to put it because you've shut the economy down, that prices are going to rise across the board for pretty much everything. You know, like a high schooler would say, duh. Okay. So now he's telling us that, well, if we do get a price hike or inflation from tariffs, I'm not going to respond to it necessarily right away because those tariff caused inflation moves might be transitory. Well, as soon as that word came out of his mouth yesterday, which I would think he would be smart enough to never utter again, a couple of reporters couldn't help themselves but properly beat him over the head with that. So, you know, you mentioned the 1970s, and I've hearkened back to this a lot of times. And Powell himself said, I'll never do it. I won't do it. I won't do it. But he's doing it. And what he's doing, or in the process of doing, is repeating the very same mistake that Arthur Burns did when he was Fed chairman in the 1970s, where under political pressure from Nixon and then Ford afterward, and as the economy was tanking at the time because of the price shock of the Arab oil embargo, first off, that caused prices to go up, this genius figured out that what you do when you've got a price shock from a one-off thing like the Arab oil embargo is you ease monetary policy. Okay, so that consumers and businesses can handle that better. Well, guess what? Whatever you do about monetary policy wasn't going to change the Arab oil embargo because it had nothing to do with monetary policy. Those costs were raised because of the embargo. So all that Burns accomplished by softening monetary policy was that then later having to double down when cheapening the dollar and lowering interest rates for a spell not only kept oil going higher, but made everything else go higher. And so now this numbskull is seemingly in the process of doing the same thing.
Yeah, they held on the interest rates, but they've been quantitative tightening for the last year, and that was the other thing that jumped off the comments that came out yesterday that had my head spinning is that they're going to go from 25 billion in tightening to only 5 billion. And I'm going, well, at the same time, you're projecting higher inflation. Isn't the reduction of your tightening program going to contribute and make that inflation even worse?
Well, it may, and this is something that Powell really didn't want to talk much about. He went on and on about, this doesn't change our monetary policy. We're slowing down the pace of unwinding of our balance sheet, reducing our balance sheet, but it may go on for longer. We just wanted to come in for a glide, not abruptly stop, et cetera, et cetera. But, and this is going to be the Achilles heel both for the Fed and for President Trump as time goes on, that long-term interest rates are still about in the middle of the range that they've been in from the bottom of rates last fall, ironically, when the Fed started cutting short-term interest rates to the spike that they had earlier this year. So, we're at 422 right now on a 10-year note as you and I are recording this. You would have thought that we would have been closer to the low in yields from last year when there's recession fears and so forth and all the uncertainty due to tariffs. But Powell himself is probably, when this is all settling out, going to cause the yield curve to re-steepen. We will go higher on long-term yields because the markets will correctly understand what he said yesterday is that he's going to sit back and do relatively little even as inflation moves back up. And part of the evidence of that is by, instead of 25 billion a month that they're going to let roll off from treasuries off their balance sheet, they didn't change the mortgage-backed securities part of it. Now it's only 5 billion a month. And of course, the Fed at some point, if the bond market vigilantes really get serious, is probably going to have to intervene more than that. So I think this is a first move toward the Fed sooner rather than later becoming once again a net buyer of treasuries when they can't sell them at a low enough price to the market, number one. The other thing he's going to have to worry about with bond yields, and I think he knows this, which is another reason why this move, at least for a little while, is going to keep the bond market vigilantes honest and looking over their shoulder, is that President Trump and the congressional Republicans did a horrible thing in recent days, basically galvanizing the fact that in this fiscal year 2025, we're going to get to the end of this September with the deficit as bad or worse than it was under Biden's last fiscal year, which ended last September. And that was because, yet again, the House Speaker, Mike Johnson, has no leadership skills. He has no real conviction to want to reduce the size of government, whatever he says publicly to the contrary. President Trump, for reasons I don't understand fully, enables this guy. And so they passed a continuing resolution to keep spending going forward essentially the same with very fractional minor differences as it was last year, which among other things means that the 130 or 50 billion of legit savings that Elon Musk and his Doge effort have done, Trump and Johnson and John Thune, the Senate leader, just threw it all away. And so that's another reason why long-term yields are going to stay high, is that these guys just proved in spades that they talk a good game about wanting to reduce government spending, but they don't have the votes, the will, the back power, or anything. And in the end, Powell will have made this situation worse when both from a fiscal and monetary standpoint and the inflation still percolating in the system, inflation starts to get away from him again potentially in the coming months. And, maybe at that point he's going to have to back off of his promise to do even 2 rate cuts. They may very well in a few months be back to talking about doing none of that, maybe going in the other direction, depending on how things evolve. So, this is what happens when you have an open-ended fractional reserve system where in the end the math doesn't work.
No, no. And one of the things that I didn't notice or heard very little discussion of, given that a lot of other analysts have been increasing the percentage of, did Paul talk about Beetlejuice? I'm sorry, I didn't mean Beetlejuice. I meant recession because we're not allowed to say that too many times because it'll pop up. Did he talk about recession? Because, a lot of economic analysts out there with some of the very large banks are very concerned, and they've been raising the percent likelihood of a recession by the third, fourth quarter this year.
Well, he did talk about it a little bit. I don't remember the exact question he was asked, but he basically did say that there's always a chance of recession. He said it's higher now than maybe it was, but it's still a 1 in 4 chance, I think, is what he said, to be fair. Now, the Atlanta Fed puts out its own separate forecast of the economy, and earlier this month, they went from a prediction of first quarter actually contraction. They had said late in February that they saw GDP at a negative 1.5%. That was at the end of February. The first week in March, their GDP now model, as they call it, said they're now looking for negative 2.8%. I did not see the most recent number. I believe it's been raised again. But as I alluded to a minute ago, we're going to be somewhere either side of the flat line, most likely when the official Q1 number comes out. Now, the textbook definition of a recession is 2 consecutive quarters of a negative GDP print. And very few are predicting that yet. There's so many things that are going on in the economy right now that are seasonal, that are one-off factors. You and I will probably mention at least copper in a few minutes and what it's done recently that I think is a major false signal to the markets in a couple of different ways. But there's been economic activity of late and probably will continue to be that might actually be masking greater economic weakness under the surface because there's been stockpiling of different kinds of metals, copper included, ahead of more tariffs going into effect on the 2nd of April, which the Orange Wonder, I think he's calling that Liberation Day. So that's one of his comical things out there. So they're going to be huge, great, never seen it before tariffs, and it's going to be a great transition for the economy and whatnot. And maybe to some extent that'll be true, but most people, myself included, believe that the near-term net result is not going to be good for the economy or the markets, either one.
I'm in that camp as well. Tariffs, typically, especially broad scope, as President Trump is proposing, all they do is cause tit for tat responses, and it's not good. It's everybody suffers into those kinds of environments. See, the 1930s is as a prime example for that. But for the first time, you and I have been doing this now for probably 4 or 5 years, where we meet after the Fed and talk about it. I think right now is the first time in those 4 or 5 years I actually feel sorry for the Fed. And let me put it to this way. You mentioned copper prices. Copper prices are high. And that generally would suggest that you have an economy that is growing and working very robustly, positively. When it's, in our case, it's not. Then you have gold prices, which are hitting all-time highs, which generally is a signal that things are bad. You have inflation that's high, so you want to lower your interest rates, but unemployment's starting to tick up. So again, everything is kind of not reacting in the way that you would expect things to react, so that you could gauge what it is that you're supposed to do far as policy. Your Fed is the only one while they're holding rates, everybody else is dropping their rates. So the US dollar is going to remain high when, the Trump administration probably wants it low. So as I say, I feel sorry for him, but what's Jerome Powell to do in these kinds of an environment?
Well, what he's going to do is shift the blame. So, he will, in the end, try and, well, first of all, yesterday he was conspicuous in numerous times saying that, that seldom has there been the uncertainty that the Fed is dealing with as it is now. He was even somewhat poking fun at their own predictions and their dot plot and everything. I don't know how anybody can make a prediction right now because there's just so many moving parts. And again, there's a lot of selective memory and a lot of hypocrisy and a lot of bullshit in what Powell says, because when it came to, for a while at least, the Biden administration's fiscal policy, it didn't matter to the Fed. What they were doing with regulations didn't matter to the Fed. But well, now there's all kinds, of excuses as to why he's got to be hostage to what President Trump is doing. And so they're all over the map as far as what could be, more so than usual. He said they're looking at 4 different things that they have to get their heads around: trade, immigration, fiscal policy, and the regulatory backdrop. Because all of them, to be fair, are going to have different impacts on economic growth and profits and the health of the economy, et cetera. And the Fed is going to have to react to that. But, and this is a story or discussion for another day, Mike, when it comes to the big picture in the first place of why we have a Federal Reserve, why we are saddled to a fractional reserve system, why the general public and for public purposes has to borrow our own credit, or what should be our own credit, from a private bank. And now we're up to $1.25 trillion interest payment run rate annually and rising. Okay, those are all questions that we've got to answer. But once upon a time, the Federal Reserve, it wasn't none of their damn business what went on Capitol Hill or Washington. Their job was maintaining a sound currency, or that was the ostensible job that the Fed had. And there were times during the Fed's history where they were doing the right thing and doing a good job, and they ignored all of this stuff that Powell now, and I guess necessarily because things are so stretched, has to worry about. And they just set a target for monetary supply growth. We're going to target 2% growth in money supply per year, period, and let the economy work itself out within that framework. And that, of course, was in the day before we had these parabolic increases in credit and debt and asset prices and stuff created by the Fed, where now monetary policy is not a governor of the economy, it sets the economy. That's unfortunately where we are. And so that's why we've got to mince words and be, so obsessed with what the Fed says, is because they are the economy. We don't have a business cycle anymore. I've explained that many times. We have a credit cycle where instead of the economy doing what it does and people make money and profits from hard work and wise investment and so forth, everything begins and ends with the Fed and how much money it makes available or doesn't.
It's puzzling to me that they've allowed inflation to occur once it occurred, and it's not a surprise that they couldn't get that genie back into the bottle. But what surprised me was that by putting the genie back in the bottle, they didn't break the labor market, because I was convinced that somehow they were going to do that. But they managed to at least avoid that and get the rate of inflation down. Although, as you and I have talked about several times, if we go back to when it started to take off, inflation is considerably higher than it's been in an awful long time, because these lower rates are based at a much higher starting point.
Well, you're exactly right. And Powell got called on that yesterday in his press conference as well. One of the reporters said, you've said that inflation expectations for the future are well anchored. I don't know what the hell you're watching, because everybody else is looking at the receipt when they went to the grocery store. And according to a couple of the recent consumer sentiment surveys that have been put out, the inflation expectations on the part of Joe Sixpack and Sally Soccer Mom are at a 30-year high right now. So he's really, being disingenuous when it comes to that. And so he finally had to come out and admit at one point that, well, yeah, people are concerned about the present price level. Well, who's the dumb bastard that made it that way in the first place? Him. So, public policy and what Congress and the president do, yeah, they have an impact as well, no question. But inflation is, like the late Milton Friedman always famously said, inflation is always and everywhere a monetary phenomenon. And when you print the kind of money that the Fed did in the wake of COVID, when you've got an economy half shut down, it shouldn't take any, a D student in an average business school will be able to tell you, or should be able to tell you, that means inflation broadly is going to rise.
Yeah, well, we took a day off last Friday, and exciting life that I lead. It meant we went to Costco over in Moncton. It's an hour and a half trip to get there, an hour and a half trip to get back. But one of the things that I really stood out to me this trip, and this is going back to when we first got here, and we were able to go to Costco again after the COVID lockdowns. My basket of groceries back then was about $400 Canadian. Same basket of groceries on Friday was pushing $700. So if you tell me there's no inflation in necessities, I'm going to tell you you're crazy.
Well, that's right. And again, we've discussed before the fact that, on the whole recession topic, half of America thinks we're already in one, and we have been for a while. And in those households, they are. There's a lot of people in this country and elsewhere that go paycheck to paycheck, and the price level is not coming back down. They can't, the rate of increase from where we're standing today is going to be increasing again, even by the Fed zone forecast. So the situation's not getting any better. And look, I've said many times that until the powers that be, and I'm not holding my breath, though I'd love to be proven wrong, really think outside the box and say, you know what, we're going to do something like a national infrastructure bank and not depend on the Fed to underwrite stimulus that we need to boost the economy, create good jobs and better paying jobs, and broaden the tax base. Or they need to go and say, you know what, we're not going to borrow our own money anymore and pay interest to a private banking cartel. What we're going to do is come out with a national credit structure, at least for certain purposes. You know, you can't just wipe away existing debt in one fell swoop. Now everything is too integrated, but you can, at least going forward, take a different road with new credit and say we're not going to borrow it from the Fed anymore. We're going to have a truly national currency, not a private banker run national currency. So until those things happen, the math just doesn't work. You know, there's this talk, and as I said a while ago, Trump and the Republican Party has spectacularly failed its first test recently in demonstrating that they are serious about bringing spending under control and bringing the deficit down. Spectacularly failed. And I'm very upset and angry about it with all of the nonsense. And even now, claiming that they're going to do this, they're going to do that. They're not doing anything. But even if they were serious, let's be real. Are you ready to say $1.25 trillion and counting of interest payments are going to be curtailed or stop, at least with new borrowing? Are you ready to really do the hard work to whittle down the military? I mean, one minute the president is saying, and this is great, that he'd love to be in a place to sit down with Russia and China and everybody cut military spending in half. That'll save $500 billion right from the get-go for the U.S. But then he turns around and at the same time he's trying to end the war in Ukraine, he wants to start a bigger one in the Middle East. So, you know, you got to make up your mind that you're going to rein in this colossus of a state, or the empire still will collapse one of these days from just being so top heavy.
We've gone around the rail here with the Fed quite a bit. We're starting to talk about some of the politics in the United States now, but earlier in the conversation, we talked about Arthur Burns and the big mistake he made, which was to bow under the political pressures, lower the interest rates prematurely, and then have inflation explode again. So yesterday was Fed Day. Generally, the day after, Trump, toilet tweets and has something to say about stuff. So I assume he has said something about yesterday's Fed announcement.
Well, he did. After the Fed meeting, I think it was late last night or some point, he put out on his Truth Social platform that he thinks the Fed would be better served and better serving of the American people if they were cutting interest rates now to ease what price increases there might be from these tariffs that are going to go into effect on Liberation Day on April 2nd, the reciprocal tariffs, as he calls them. There's still a little mystery as far as how far he's going to go on those dates. I mean, is he going to be, having triple-digit tariffs on Europe and Japan for things that they tariff us at that rate, which is frankly is more fair if you're really worried about reciprocal than some of the stuff that's been discussed where our closer trading partners, Mexico and Canada, are concerned. So there's still some mystery as to specifics of what he's going to do. There's also a legal argument that's ongoing within the Oval Office of trying to curtail some of what he wants to do with both Canada and Mexico, because after all, he was the one that signed the upgrade to NAFTA during Trump 1.0, and that, of course, is called the USMCA. And that sets a framework by the treaty that he himself signed as to what he can and cannot do where tariffs are concerned. So, there's still some angst here, but, he wants the Fed to give him a pass, essentially, on decisions he is making and about to make that may not be in the best interest and may cause some economic harm. He's tried to prepare the American people for that. He's talked about this transition from the old economy to the new one that's more America first, more domestic manufacturing, less government spending, on and on and on. His Treasury Secretary, Scott Bessent, has talked about a detox that we have to have. Well, if you really believe that, then you don't need the Fed to make it better. If to make it better in your mind, it's going to cause overall inflation to rise even more than it would have otherwise. So, yesterday, quite honestly, and I don't think he would ever want to describe it or admit it as such, the Fed chairman already did take a step toward President Trump's position by suggesting that even if inflation ticks back up from 2.5 to 2.8% this year, even as the economy slows, even with some of the inflation impact being from these tariffs, he will still, or the Fed will still, by yesterday's math, cut interest rates another 50 basis points during the year. Of course, if Trump had his way, they'd be doing a lot more than that. So we'll see what happens. I don't think that Jerome Powell is going to publicly answer what the president has said. Probably the next time he's running around giving a speech here or there between now and the next Fed meeting, I'm sure he'll be asked about this and maybe or maybe not say something. But, I don't think Trump's going to get what he wants, but for the reasons that I pointed out when we first started this discussion that go beyond even the tariff thing, I think Powell has already kind of blinked when it comes to the idea that they really can't respond much more than they've already done to still sticky, if not rising inflation.
One of the things that we've talked about in the past is the potential of mommy and daddy fighting, the Fed and Trump. Are we closer to there being a fight, or are they still in neutral corners?
Well, I think they're largely in neutral corners. Bessent has, been the bad cop, I guess, but a mild version of one. Maybe that's not even the right characterization recently by saying, well, look, Trump, the president's not going to try and, berate Jerome Powell. He's not going to try and force him on short-term rates. We believe we can lower long-term rates if we get our policies into effect. And so that, as of the moment, is the official talking point of the Trump administration. Less about, telling Powell he's got to cut short-term rates, but more about pushing for the kind of policies that would bring long-term interest rates down, because that's what matters to the average borrower. But again, they just undermine themselves terribly by locking in the federal spending level of last year, because these guys don't have the will or leadership to really cut spending and come up with actual real budgets. Still, contrary to Speaker Mike Johnson's promises more than once. So that's not going to help them in the cause of bringing down long-term costs. And look, even though long-term yields softened again in the last couple or 3 days, there's not a whole lot of room for them to come down. And you really got to have your head examined right now if you're going to think that this is the time to be buying long-term treasuries when the Fed just told you they see inflation rising again. The markets will still stay reasonably liquid, even if stocks still need to continue repricing in this correction slash bear market that's underway. Long-term yields are more likely than not to go up again. And that's what's going to start to really make the Trump agenda suspect. I mean, already there's some danger, and I've said this before, I've warned about this, that this whole idea of Trump getting his one big beautiful bill that's going to extend 2017's tax cuts and add other tax cuts, get rid of taxes on tips, outlaw the taxes on Social Security benefits for seniors, et cetera, et cetera. The market's not going to be friendly to that, because all of these things net are only going to increase the deficit further. And so, by president appearances, and I would love to be proven wrong on this, because I don't want to see what is otherwise a great and badly needed political realignment here in the US. I don't want to see it undermined inside of 2 years if we get to the midterm elections next fall and the deficit is higher than when Trump took office. Inflation and interest rates are also perhaps higher than when he took office. We're in a recession, and people start resurrecting the moniker that George Bush Sr. once used against Ronald Reagan, incorrectly, as history proved, but it won't matter. And they'll say, look, we told you that this guy's voodoo economics and trickle down stuff wasn't going to work. Now we're in a bigger mess than you thought we were in with Biden. And the Republicans will get their butts kicked in the midterms, and they'll deserve it because they didn't deliver. So the clock's ticking. And what's going to be required to bring down these long-term borrowing costs is being undermined.
Well, Congress and the Senate do have an opportunity at a do-over in September. They've only kicked the can down the road 6 months, as they're apt to do. They don't seem to want to solve this problem in a long-term basis. Do they do a course correction, or are they so locked into their positions that what you're saying is going to come to fruition?
I'm not real optimistic in a big picture, I have to say. One of the many things I talked about when I've said since the beginning of the year, my theme for 2025, let's do the math. Trump was starting with a bad hand, number one. Okay, we're overdue for recession. We were already overdue for stock market correction. I don't care if Trump or Kamala Harris or Pee Wee Herman had been elected. Things weren't going to be a whole hell of a lot different than they are right now, number one. Number two, the Congress, the math where Congress is concerned, Mike, is you've got minorities in the House and in the Senate both that went along with these continuing resolutions, regrettably, with the sole exception being Republican Congressman Tom Massey from Kentucky, who is really a true statesman. These minorities in the House and the Senate have very different views of why they don't like conventional Republican priorities. In the Senate, Rand Paul from Kentucky, the senator, decided that even though everybody in the Senate, Republican-wise, was holding their nose and voting for this continuing resolution, he put everybody on the spot and said, okay, let's see how serious we really are. And he introduced a measure that, we'll still postpone all of the individual budget bills. There's supposed to be like a dozen of them total that they should be settling on individually. And maybe they still will between now and September, but I'm not holding my breath. And he said, let's at least take the savings on foreign aid from all of the graft and everything that Doge and Elon Musk have uncovered, and let's at least legislate today on that and codify that. And half the Republicans in the Senate refused to do that because you've still got a culture, even among a lot of Republicans, and especially in the Senate. These are globalists. These are people who want to maintain the American empire, even contrary to what the Trump-Vance team wants. They're people who want to maintain the ability to launder money. They want to maintain the ability to keep their mitts in other countries and dictate policies in other countries and so forth. And look, if you've still got half Republicans in the Senate who, when it comes to something as simple as this measure the other day that Paul introduced really was, and they can't even get on board with that, then I'm not that hopeful that they're going to do what needs to be done to meaningfully reduce government spending. And that means, wrapping up this thought, Mike, that when Trump and especially Bessent claim that they can cut the deficit in half or more than in half from where it is lately, keep economic growth high, drill baby drill with the economy and stuff. This is a fantasy. This is worse than voodoo economics, as George Bush Sr. once termed it. And so these guys, and I hate to say it, Trump is the self-proclaimed king of debt in the private sector, but I don't think it's going to go as well for him politically or for the country financially in the public sector if he and Republicans don't get truly serious, because right now they're very unserious.
Yeah, it's interesting times to say the least, and I don't see them getting any less interesting in the short term. So lots to unpack in the coming months, and if people want to follow your musings as we go forward, how would they do so, Chris?
Simply go to nationalinvestor.com. You can follow me on social media. The links are there. If you're not already on my mailing list, at least get on the free version of it for some general market commentary and so forth. But I have to tell you that we've been pretty active lately with rearranging our portfolios. I've added a few new themes recently, a really provocative one this morning, in fact. And so if you want access to that, there's a special offer. If you click on subscribe or renew to avail yourself of that.
Perfect. I'm sure we're going to have lots to talk about in the coming days, and I look forward to having you back on. Thanks for coming on again.
All right. Take care, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.